Hello, everyone. Today on the final bar, I'll be talking with Sean McLaughlin of All-Star Charts. We'll talk about a couple setups that are coming up on Sean's radar. We'll also talk about this market rolling over going into the close. The last hour of trading yesterday, fairly strong. Today, pretty weak with the S&P closing below 4,100. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close for our show as we break down the activity in the markets through the lens of technical analysis. The technical toolkit is designed to help you appreciate the values embedded in price and breadth and sentiment, helping you understand investor psychology, respect in market dynamics, and learn the lessons of market history. We hope to cover all three every time we do the show. Bit of a weakness here going into the close. We opened lower, but through the course of the morning into the afternoon, had continued to push to the upside. All of that changed in the last hour of trading. About 3 p.m. Eastern, we rolled over pretty aggressively, made a new swing low there going into the close, closing below the opening trades with the S&P down around 40.90. What does this mean for this broad bullish recovery phase we've been talking about? It stays still pretty much in decent shape, but it starts to bring up question marks in my mind when we get below 4,100. But look at a chart of the S&P and some other techniques. And we'll also dig into some breadth indicators as well. Let's get right into our market recap. Looking at the S&P yesterday to today, the big stark contrast, in my opinion, is in that last hour of trading. Look how yesterday from 3 to 4 p.m., we rally, we make a new high for the day. Going into the close, the S&P getting above 4140, looks long and strong, pretty constructive. Compare that to today, where the last hour up puts us back below the opening range of the day, down to around 4090. So certainly a different feel, kind of limping into the close. This is one of those where you just want to get to halftime and just sort of cut the game off, stop the pain here. And that's sort of what happened. Again, still in decent shape. And I would say a lot of individual stocks obviously still holding up, but you're seeing a lot of weakness from the FANG sectors today. And that was a change from what we've seen in a lot of the sort of the average day in 2023 has been those FANG sectors looking pretty strong, growth over value. Today, a little bit different. We'll go through all those themes here in a minute. Looking at the S&P, as I mentioned, closing around 4090, that's down about 1.4% from yesterday's close. The NASDAQ 100 down almost 2% to 12,442, just above there. Mid caps and small caps both down as well. But the S&P led the way lower. Really, the NASDAQ did. But in terms of large versus mid versus small caps, it was the large cap stocks struggling the most. And again, it's sort of that mega cap FANG trade leading the way lower. The VIX, after just yesterday, we spent a good amount of time talking about volatility, all of a sudden getting lower. The VIX getting down toward 18. This is thinking like, all right, is this a more maturing bull market phase on lower volatility? I guess not. The VIX gaining about 2 points today, back above 20 to 2024. Interest rates overall higher today, and I think that's certainly part of the story. Bond prices moving lower. I had a really good conversation yesterday with Greg Harmon of Dragonfly Capital, and we looked at his long-term chart of long bond prices and thinking about that, that weakness that we may be seeing here in bonds. You're certainly seeing that reflected today with bonds coming down. We're using the TLT, which is a long bond ETF. You can see rates, of course, going higher. 10-year yield around 384, 5-year yields 440, we'll call it 405. Dollar index, not too much of a change from yesterday. We talked about that long-term trend in the dollar, strong through much of 2022, much weaker in the fourth quarter, and that sort of set us up for a nice rally off of the October low for the S&P and the NASDAQ. The question I would argue, if you're bullish, is can it withstand a stronger dollar environment? Today, not as much of the story, sort of flat from yesterday, but when I'm thinking of the chart of the dollar, that's the biggest area of focus for me. Gold had actually been in the positive for most of the afternoon, but managed to roll back over along with equities in the last hour of trading. The GLD has finished just below flat for the day, not a huge change. Copper price is actually higher, but energy prices, generally speaking, weaker from yesterday. You know, what's interesting is we're so used to cryptocurrencies and stocks moving in concert a lot of ways, right? Meaning, sort of thinking of Bitcoin and Ethereum and others as risk assets along with equities. They came down in the last hour of trading just like equities did, but overall, you've seen a bit of a divergence here, certainly recently, as Bitcoin and Ethereum have really rotated to the upside. Bitcoin came off quite a bit today, touched 25,000 today, which it's not been near for many, many moons. We're actually back to that 25,000 level. Came off a bit. It's around 24,500 here just after 4 p.m. Eastern, and Ether price is up about 0.25% from yesterday. The rest of the top 10 cryptocurrencies that we track on our platform, all in the red. Let's look briefly at a chart of the S&P 500. We'll come back and check in on a number of other themes to tease out. You know, we've talked a lot about this blue shaded area, which is the range between 4,000 and 4,100 on the S&P 500. This is based on traditional support and resistance. So you can see that a lot of the peaks that we've seen over the last couple months have been either at 4,000 or at 4,100. That's part of why this is important, but it also encapsulates some Fibonacci ratios, which we've or levels that we've been paying attention to, and so forth. So getting above that range was meaningful, which is why we saw the beginning of February as a pretty bullish follow through. The fact that we'd not just traded to resistance, which is what happened in November and December, but actually traded through resistance. That's where things really started to change. So many attempts to get above the 200-day, to get above trendline resistance, all failing. All of a sudden, they all are violated here in a bullish way in January. From there, we now broke to a new swing high, tested 4,200. From there, we've settled back a bit, right? And that day where we almost got to 4,200 has been the high water mark for the S&P in February. Now we're sort of chopping around here. We're once again closing below 4,100. And we've talked about, my opinion, in the short term, for sure, I think it's all about a line in the sand, right? Do we break out and then we hold that breakout level? That's why when we have an inverted head and shoulders, like we've seen on a lot of stocks in the last couple months, when you break above that neckline, the question is, do you hold the neckline when you come back down? I think that's kind of the question mark for the S&P right here. Today, it's closing below 4,100. We've done that a couple times, and each one of those times in the last couple of weeks, we've been able to bounce back to the upside. So I would look for support within that blue shaded area. So far, we're seeing it. If we get below and outside of there, particularly below the 200-day moving average at 39.40, we'll call it, then all of a sudden the chart has a very different look. All of a sudden this feels a lot more like a retracement, retesting some sort of support levels. And I think you have to bring more risk management certainly into your awareness. Looking back at the sectors and thinking about risk management, a lot of the FANG sectors have had incredible runs, certainly off of the lows. And that's just sort of a growth story with rates remaining fairly low. It's not true. I mean, fairly high relative to recent years, but low relative to 4.25 on the 10-year yield, which was last year's peak. If you look at what's happened in 2023, it's been a return to the growth story with consumer discretionary, technology, communication services all having pretty decent years so far. Today, giving some of those gains back, the XLY down over 2%. That was the worst performing sector out of the 11. Technology was number 2, communications number 3, all down at least 1.5% today, underperforming the S&P 500. The best performing sectors were still very much in the red. So consumer staples and utilities were both down about 0.7 to 0.8% today, followed by real estate and energy. So very much a defensives at the top and growthy offense at the bottom, but everything pretty much in the red there. Now you do have some noticeable outliers, and I think on a day like today where you have a big move lower, I naturally want, or not a big move, but a non-up day, right? You want to naturally look at the stocks that actually did well, right? Where were assets rotating as the major averages, as a lot of the key mega cap stocks we follow are on the downside. So the groups that did particularly well today: telecom equipment, which is in the technology sector for us, the coal group, which is a small group within energy, and then some materials, some industrials. Waste and disposal services comes to mind. You can see RSG on the list here. We've talked recently about A lot of these names, Waste Management and others that have had some pretty decent setups. What's interesting about charts like Republic Services is they are bouncing off support. And while we are thinking of a lot of names like Tesla that have had big runs, names that have gapped higher and now potentially rolling over, this is sort of the opposite. These are names that have been underperforming over the last 3 to 4 months. Now, all of a sudden, finding a bit of a floor, finding a support level, and then rotating back to the upside. And so RSG up about 3% today. I don't know if this is the most perfect chart I've ever seen, but it's certainly moving higher while the rest of the world seems not to be. And I'm noticing that the momentum is actually getting pretty constructive, right? The RSI getting above 60 today might be an important data point to look at as well. Talk about PDD, Pinduoduo, and the reason why I'm highlighting this name, it's the top ranked stock in our Scooter large cap rankings. So we have a StockCharts technical ranking that we produce. It's a proprietary methodology, although we give you the formulas we're using on our chart school pages, but we rank a group of stocks within large caps, mid caps, small caps. Then we have some international universes that we do, also industries and ETFs, all with their own rankings. So you can look at a percentile basis on which charts are stronger than others based on traditional technical trend following tools. Pinduoduo at this point has the strongest ranking of all the large cap space. What's interesting to me is it's setting up as what we'd probably call the fat pitch chart. If you know baseball, a fat pitch is a pitch right over the plate, regardless of what the count is. You probably want to take a swing because it's just a pretty good setup. So something like PDD, which has had a pretty good run of performance, the momentum overall has been pretty strong. The relative strength has been strong over the last 12 months. It's been fairly consistently outperforming the S&P, but in the short term, it's pulling back to an ascending 50-day moving average or a 10-week moving average. Could be a really interesting setup here and an opportunity to buy in on short-term weakness within a stock that's had a fairly constructive run here for quite some time. Just to finish off, I want to look at the Mindful Investor chart list. 2 breadth charts I'll highlight for you. Number 1 would be the percent of stocks above their moving averages. Right now, as of the close today, 69% of the S&P members remain above their 200-day moving average. 65 remain above their 50-day moving average. Those are still kind of bull market numbers. If you look back here in December, I think one of the great tells over the last 3 months was when we broke out in November, we pulled back. You can see that both of these indicators bottomed out right about 50%. That means even with the drawdown, you had at least half of the S&P members remaining above those sort of trend following mechanisms, for lack of a better term. Final one that we have to take a break is the McLaughlin oscillator broke below zero the first week in February. Overall, we've held our ground and for the most part remained above 4,100. The McLaughlin oscillator popping higher a little bit, but when it breaks below zero, you can see what's happened in these previous times over the last year when that's been the case. Suggests, at least in the short term on that tactical time frame, weakness over strength. Let's take a quick commercial break. We'll be back with today's guest, Sean McLaughlin. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. We did a really good test of our new StockCharts TV studio earlier this week. We hope to get in there very, very soon. We have a lot of good plans for this show, building it out to a little longer time, to about an hour, and bringing on more really cool segments to share with you and hope to illuminate these markets for you. We're going to bring on today's guest, Sean McLaughlin, here in a moment. A couple quick announcements before we do it. First off, we welcome your questions. We're going to do a mailbag segment tomorrow on Friday's show, and we love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter @finalbarsctv, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to hear from you and answer your question live on the air on Friday's show. Upcoming schedule, some pretty good guests. We've had some great conversations this week, and we'll have more next week. On Tuesday, the 21st, we have Danielle Shea, who's an options strategist at Simpler Trading. On Wednesday, February 22nd, Dave Landry of DaveLandry.com. On Thursday, February 23rd, Louis Yanis, WealthNet Advisors, is going to be joining us as well. Also wanted to let you know about our latest upcoming free webcast with market misbehavior called 5 Favorite Breadth Indicators, the percent of stocks above their 50 and 200-day moving average, the McClellan Oscillator, just 2 of the 5 we will break down. We'll talk about how they're constructed, what they mean, look at some history in terms of what signals they've generated, and focus on what they're telling us about the market environment right now. You can sign up for that free event at marketmisbehavior.com/breadth. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at StockCharts, coming to us from Boulder, Colorado, a frequent guest on the show. Sean, welcome back. It's good to see you.
David, always great to see you, buddy. Thanks for having me back.
It's a pleasure. We have a lot to talk about. Of course, a lot of places we could go. You brought a couple names with you that sort of come up on your radar as you're looking for ideas here. Starting with Goldman Sachs, and I want to segue with the Economist cover, which I know a number of us saw with the Goldman logo sort of melting. Is that setting us up for what you're going to tell us about the chart?
Oh, we're jumping right in. All right, I like it. So at StockCharts, it's no secret, we're big fans of fading big magazine covers. Our favorite is when we see financial news making its way to non-financial publications. Think Time Magazine, things like that. That's our favorite indicator. But another close second for us is whenever the Economist goes out there and makes a loud statement about a household name. And in this case, Goldman Sachs. I mean, you can see from that picture that David's showing, Goldman Sachs, the Economist is making the case that the best days for Goldman are behind it. Maybe that's true. I don't know. But David, you and I, we're technicians. When you pull that chart up, we're looking at that chart, and there's nothing about that chart that tells me that danger is imminent. In fact, it feels to us it's telling us the exact opposite.
It's interesting how much the financial sector, which I feel like is a sector that so many of us have learned to probably just ignore because it's been a non-factor. All of a sudden, when you look at the last, 3 to 6 months, there've been some emerging strength in a lot of names. I mean, not just Goldman, but Morgan Stanley, JP Morgan, and a lot of other names, insurance companies, of course. When you're looking at the chart of GS at this moment, how would you approach it? How would you play it?
Well, let's take a step back and kind of look at it from a bigger picture. The stock market over the last 6 to 8 months, this has been a very unpopular opinion up until recently. We've been in a bull market, maybe a stealth bull market. There's been a lot of stocks. There's been more stocks making new highs than stocks making new lows. Now, it hasn't necessarily been reflected in the indexes this entire time. But if you look under the hood like we do, we've been seeing a lot of new highs, a lot of stocks performing well, basically bull market conditions. And I think you might believe this, David. If not, that's fine. But we believe here that you can't have a bull market without financials. Financials are going to participate, if not lead. And Goldman Sachs is, the best name in the business, right? And if this bull market is still going to continue on like we think it will, it makes complete sense to us that Goldman's going to be one of the leaders. And that's why we're bullish. Another reason why we're bullish.
It's such an interesting area. And again, I feel like so many investors, particularly newer investors, think of the influx of novice investors in the last couple of years. Most of them have not experienced a situation where financials are a decent long-term bet, right? That they've been struggling in the last couple of years in sort of the whole COVID area. From a technical perspective, what would tell you maybe that Goldman was not a good play anymore? Is there a certain signal, a certain level that you would break down, or how would you approach it from a technical perspective?
Sure. I'm a little bit more of a shorter term trader than perhaps some of your other guests. I'm an options trader, right? So I have a limited time frame for my trades to work. And so I put an options trade on in Goldman Sachs. The bet that we're making is that Goldman's going to travel through the 400s this summer. We bought a bull call spread, meaning we bought January calls. So we have 10 months until they expire. Right. We bought the 400 strike calls and we sold the 500 strike calls against it just to lower our cost and increase our odds of success. But that's the play we're making. But meanwhile, I'm keeping a really tight lid on risk management. Basically, if we get below about 363, I think 360 is really the dead, that's it, drop dead for me. If we can't hold 360, then I'm out of the trade, and I'm either early or wrong, and either way, it's the same result.
It's not going to feel good either way, right?
Yeah.
Your second chart, and I appreciate you talking through that one. Your second one's CHWY. CHWY is an interesting chart because it's really sort of testing that resistance level right around $50. Talk us through this one if you could.
Well, David, before I do that, if you don't mind, I'd like to throw you a wrinkle here because you spurred something while you were talking before.
Yeah, do it.
Is it possible for you to bring that SPX chart back up?
Yeah, of course.
Okay, great. So when when you were talking about the SPX chart, it got me thinking. I was looking at this, and as I mentioned just moments ago, that we've been, depending on where you look, we've been in a bit of a stealth bull market for the past 6 months. And I shouldn't say nobody, but very few people wanted to believe it. Yeah. In recent weeks, it's kind of like people are reluctantly coming around to the fact that, oh, maybe we are in a bull market. But those same people are saying, oh yeah, we've been in the bull market, but now we've gone too far. We've gone too far. We need to pull back. And I'm sure today's trading action, the way we close, is going to give them even more fuel to feel that way. Yeah. But when you look at this SPY chart or SPX chart, I feel like, hey, we broke above that range. Now we're just kind of consolidating, making those gains stick a little bit. And it feels to me we're just prepping for another move higher. And so now you can bring that CHWY chart up because I feel like this lends itself well. There's a mindset in the market now that we've come too far too fast, and these are the people that are late to the whole bull market idea. Yeah. And a lot of these people are getting aggressively short or certainly not buying. And in a name like CHWY, and there's a lot of names out there like this, but CHWY is one of my favorites. 26% as of the last day that we have. 26% of the shares outstanding in CHWY right now are held in short positions, David. Now, I think that what happens when you're in a losing position, when you're short and you're losing, the only way you make that pain stop is to buy back the stock to close the position. And if this CHWY gets above, let's say $50 a share, there's going to be a lot of people in short positions starting to lose money rapidly. And this thing, after forming a great base and really, kind of holding the gains off of the summer lows, this thing could get moving in a hurry. And that short interest is going to be fuel to the fire. And I think that we're going to see that not just in CHWY, but in a lot of names, and because there's a lot of people still waking up to the idea that, oh, maybe we are in a bull market here.
It's so interesting. The dreaded short squeeze, right? When people get caught on the wrong side of it and have to cover, and that can just be fuel to a bullish fire on charts like this. We have a couple minutes left, Sean. I'd love to ask you about a couple names that have had some pretty good runs here. Tesla is one that's come up a couple times on the show here recently. A name that's, down almost to 100 now, and now over 200. Pulled back today a little bit, but overall the trend has been accelerating to the upside. When you look at a chart like this, how would you approach it if you could from using options if you're concerned about the downside risk? How do you approach something like this, or how would you think of it using the options market?
Well, I'm going to take that one step further and say, let's say I'm somebody who's been bullish on Tesla this year since 2023, right? You bought the dip, you've been riding it up, you've got some good gains here, and now you're starting to get a little nervous, right? Like, you got a good win, but you don't want to let it go. Well, one great way that the options market can help you out here, especially right now, because the implied volatility in Tesla options is pretty elevated, meaning the premiums are pretty expensive in both directions, whether you're buying calls or puts. Well, one way, if you're a holder of Tesla stock here and you want to ride out what you think is going to be some coming volatility, a great move in a situation like this is you could sell out of the money calls against your stock. So think of it as a covered call position, right?
Yep.
You could sell the out of the money calls, turn around and take that money that you just received for that and purchase out of the money puts. And basically, depending on which strikes you pick, you could put the trade on for free. So basically you have a free hedge. It didn't cost you any money. You'll have defined risk. Let's say I'm just making numbers up here, David, because I haven't looked at the strikes, but it looks like it closed at 202 today.
Yep.
Maybe you go out into April options and you sell the 225 strike, which lines up with that 200-day moving average. You sell the 225s and you turn around and buy the 180 puts. And you could probably do that for pretty close to even. And hey, you might have some risk down to 180, but that's it. That would help me sleep a lot better at night if I was sitting on some big gains in Tesla.
Right. So that what you're basically doing is limiting your downside, right? So you have a defined bottom in terms of your downside being zero, right? Your downside has a lower floor to it. That's really, really helpful, actually.
Right. And look, it's going to cap your gains. If Tesla just continues ripping higher from here, you're going to be kicking yourself that you hedged up your position. But you know what? there's no free lunch out there. And if you think if you think you're heading in for some volatility, this will at least allow you to ride out that volatility from now until the expiration of those options. And then you can reassess where you're at after that.
I'd love to just ask about one more, if we could. Meta is a stock that we were talking about with the guest earlier this week, gapping higher to about 180. And from there, the question mark, and you've seen a number like West, WST, Twilio just gapped higher today. And the question is, do they continue? This one so far has kind of stalled out and rolled over. What's your take on a name like this that appeared to have a pretty bullish jump, but now all of a sudden fading to the downside?
It's funny you bring this up, David, because just yesterday, our analyst team at StockCharts, this was a hot idea on our radar. We were talking about this. We liked this as a gap and go type trade. We liked how it gapped above 180 and that it had been consolidating over the last 2 weeks. However, when we were looking at this trade yesterday, we were saying, hey, we could get into this trade. We can have a really tight stop. So we could have we could structure it in a way that we could have a lot of, high reward to risk scenario. However, we breached that level we were watching just today because we were kind of looking at 175 as, that's the level we'd lean against. Or actually like 174, I think, is the level we'd lean against. And we're below it today. So maybe we dodged a bullet there. We didn't put the trade on. So we'll see. But I don't like it right now where it's at. If it can get back and maybe climb back above 180, then maybe the gap and go trade is on. But for right now, I think it's just kind of sit on your hands and wait and see what happens.
Yeah, I think that's a great take. And looking for follow through on names like this didn't happen here. We've seen it in other places. Maybe be patient is a good takeaway. Sean, listen, this has been such a great conversation. Thank you so much for coming on. Thanks for highlighting the Goldman cover. I'd forgotten about that one. And be well there in Colorado. We'll talk to you again soon. All right.
All right. Thanks, David. Always a pleasure.
That's Sean McLaughlin. Sean's the chief options strategist at StockCharts, coming to us from Boulder, Colorado. I love just being able to talk with someone like Sean about thinking about some of these potential trades and also thinking about options. I know for a lot of investors, if you're sort of in plain vanilla equities and ETFs, the options market a lot of times can provide some additional opportunities, right? Some additional levers to play, at least to clearly define your risk, which is one of the questions that I know for equity investors a lot of times can be a challenge. As a reminder, we now have options data on the StockCharts platform. One of the many upgrades we'll do to covering non-equity and ETF asset classes and trades. So look for more to come, but you can look at full options chains on the StockCharts platform. We need to wrap the show, folks. Go to the 3 in 3. Let's look at 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. Interest rates going higher today, and that's certainly putting a damper on the FANG stocks, the phenomena stocks, as I call them, that general growth trade. Higher rates don't tend to be a good sign for those stocks because their potential earnings growth becomes a lot less valuable if rates are going up, is how I would generally describe it. When I'm looking at the bond ETFs like AG and TLT and LQD and others, sort of those broad bond ETFs, AG stands out to me as having just a textbook bearish momentum divergence. This is when prices go higher over a period of time and the momentum actually goes lower, right? So higher prices December into January, but look how every move higher was on lower momentum. So what that basically tells you, it suggests that the uptrend is exhausted. It's just a rollover is likely, and that's certainly what we've seen now in the month of February. So now we've broken back below moving average support. We're now testing the previous lows around 97, just below there. The RSI getting below 40, I think is sort of a negative development there. Chart number 2, Meta. I loved Sean's take on this and just thinking about it again. Talking to options guys, you spend a lot more time thinking about volatility and also specific price levels because you need to be thinking about strike prices and premiums and how you're going to structure an options trade. I love his thought about, looking for follow through, which we didn't have. Names like this gap higher. The question is, do you see additional demand after the gap? We've not seen that in this case. And while there are plenty of ways to potentially manage the downside risk, I'm skeptical on a name that gaps upwards, and then that's it. We're seeing the chart continue to roll over into today's close. Finally, I was scanning using our scanning engine for ETFs that were getting a buy signal from the MACD indicator. You know what came up? Short Q's ETF, short NASDAQ ETFs, the PSQ and others, even the leverage ones, came up on the scan that I was running there. Not a great sign for the NASDAQ 100. You see the opposite. You see a sell signal from the QQQ today. What that means is basically it's been a big move to the downside on this short ETF. You're seeing it potentially rotate higher. Here's the buy signal that our scanning engine identified. The last time we were this low and generated a buy signal was at the August peak for the S&P and the NASDAQ, meaning the short ETF went higher. Folks, that's a wrap for this show. Thanks so much for joining us every weekday after the close. Special thank you to Sean McLaughlin of All-Star Charts, joining us from Boulder, Colorado. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.